RCI Hospitality Holdings, ticker symbol RICK, they just posted a definitive beat against Wall Street consensus for their fiscal Q3 2026. Non-GAAP EPS came in at 90 cents, safely clearing that 82-cent expectation alongside a GAAP EPS of 83 cents.
Right.
And revenue hit 73.9 million, which is a 4% increase year over year. Management actually skipped formal quarterly guidance, opting instead to just, reiterate their long-term FY29 targets. That's 400 million in revenue and 75 million in free cash flow.
Which the market obviously loved.
Oh, immediately. Shares popped 6.97% in the next regular session, closing at 28.07. And they did that trading on triple its 20-day average volume.
Yeah, that volume spike is really the crucial indicator here. I mean, seeing a stock trade on 3 times its average volume following what's really a relatively modest 4% top-line revenue growth, that signals heavy institutional accumulation.
Yeah, totally.
The market wasn't just buying the top line. Portfolio managers were looking under the hood at the underlying margin expansion and, honestly, the sheer aggressiveness of their balance sheet cleanup.
And that is exactly the core puzzle we need to pull apart today. Because squeezing a massive earnings beat out of just a 4% revenue bump, that requires some serious operational leverage.
Absolutely.
We're going to look at the mechanics of this beat, specifically how they're engineering margins in their core nightclubs business, this sudden turnaround at their bombshells sports bar segment, and like you mentioned, that strict capital allocation strategy that clearly triggered the institutional buying.
Right. So to really understand it, you have to start with the nightclub segment. That's the engine of this company.
The cash cow.
Exactly, the cash cow. And it provides the clearest picture of how they're manufacturing these margins. I mean, revenue in that segment ticked up just 1% to 63 million.
Which is basically flat.
Yeah, 1% is essentially flat, especially in this current macroeconomic environment. Yet somehow, GAAP operating margins for the segment jumped from 28.6% a year ago to 31.2%.
Well, wait, if you keep revenue practically flat, how do you magically expand margins by almost 300 basis points? You aren't exactly bringing in a flood of new customers to dilute those fixed costs.
No, you're not.
The numbers show it was driven by a 7.6% jump in service revenue, which, in the nightclub business, that translates directly to VIP room and bottle spend.
Yep.
Interim CEO Travis Reese used this very specific analogy on the earnings call to explain it. He called it the 737 airplane effect.
Oh, I loved that analogy.
Right, it's so good. The idea is, if you are the only passenger on a flight, you have zero incentive to pay for a first-class upgrade. You can just stretch out across 3 seats and coach.
Sure.
But if the back of that 737 is packed shoulder to shoulder, suddenly you are highly motivated to pay a massive premium just to get some breathing room. So how are they actually executing this on the floor?
It is a really brilliant application of spatial economics, honestly. It's manufactured scarcity. Because when you look at the unit economics of a nightclub, your general admission cover charge and your basic floor bar sales, those are really just designed to cover the heavy fixed costs.
The overhead.
Right. The lease, the massive air conditioning bills in Texas, the lighting, security staff, bartenders, all of that is basically paid for by the crowd just standing on the floor.
So by the time someone actually decides to book a VIP section, the building itself is already breaking even.
Exactly. The flow-through on that VIP spend is astronomical. The markup on a bottle of premium liquor in a VIP section is legendary. We're talking often 1,000% or more.
Wow.
And because those fixed costs are already covered by the main floor, almost every single dollar of that VIP premium drops straight to the operating profit line. But to force that upgrade, management really had to fundamentally alter the floor dynamic.
Packing the floor.
Right. They've aggressively broadened their demographic targeting to do it.
Yeah. The sources highlight a major influx of younger tech workers, crypto investors, social media influencers, which, that is a really noticeable pivot from the traditional corporate expense account client that usually anchors the specific industry.
Well, and the traditional corporate client is still there.
Sure.
But by marketing heavily to this new wave of younger, highly liquid wealth, they are fundamentally changing the psychology of the room. This new demographic is highly motivated by status signaling, right?
Yeah.
And experiential spending.
Okay, I see where this is going.
Plus, management is actively funneling this broader demographic into concentrated weekend windows. They're specifically targeting couples and bachelor parties on Saturdays.
So they are intentionally flooding the main floor to create friction.
Exactly. I mean, you have to realize that friction is the product. They are purposefully making the general admission area feel chaotic and crowded. If you are, say, a crypto millionaire or a real estate developer walking into that environment, The sheer density of the room heavily incentivizes you to pay an exorbitant premium just to escape the crowd and, signal your status.
Yeah, you don't need 100 new customers walking through the door if you can engineer an environment where your top 10 customers willingly double their spend.
Precisely. It maximizes the yield on every square foot of real estate. You don't have to rely on massive top-line customer acquisition.
It's just manufactured FOMO. And it's clearly padding the margins in the nightclubs. But realistically, there is a ceiling to that, right?
Oh, absolutely.
You can only squeeze so much yield out of a VIP room before you hit hard capacity constraints. So to actually shock Wall Street this quarter the way they did, they needed a secondary catalyst. And that catalyst was the complete reversal of fortune at their Bombshells sports bar concept.
Yeah, the operational leverage they achieved at Bombshells this quarter is really what shifted the entire narrative for the stock.
I mean, the numbers on this segment are honestly jarring. Revenue surged 25.4% to $10.8 million. Same-store sales were up 4.7%. But the real story, the thing jumping off the page, is the profitability.
It's wild.
Operating income skyrocketed from a meager $67,000 a year ago to $759,000 this quarter. Operating margins leaped from 0.8% to 7.0%.
Yeah.
I really want to push on how this actually happened, because previous management was reportedly trying to run Bombshells like a standard, family-friendly, casual dining restaurant, right?
Right, they were closing locations at midnight.
Closing at midnight. And then Travis Reese stepped in, gutted that strategy, and reverted to a late-night sports bar and entertainment model. No nudity, just sports, good food, and a party atmosphere. Why does keeping the doors open just a few hours later radically alter the underlying economics of the whole business?
Well, you really have to look at the severe differences in product mix economics, specifically between food and alcohol. Anyone who's run a kitchen knows it is notoriously brutal.
Oh, the worst.
Food comes with high spoilage rates, massive supply chain volatility, and it requires intensive, highly skilled labor for preparation. The margins are paper thin even on a good day.
Right.
Alcohol is the exact opposite. A keg of beer or a bottle of vodka has virtually zero spoilage, it requires minimal labor to pour, and it carries a massive markup.
And the sources note that management successfully shifted the sales mix at Bombshells from roughly a 50-50 split between food and beverage, pushing it to a 62% to 64% beverage mix this quarter.
And that 12 to 14 percentage point swing in the mix, that is the entire ballgame.
Really?
Oh yeah, because alcohol carries significantly higher margins.
Yeah.
Every marginal dollar of beverage sales drops to the bottom line much, much faster than a dollar of food sales. By reverting to that late-night model and keeping the doors open past midnight, they aren't just adding random revenue
They're
hours.
filtering the customer base.
Exactly. They're specifically capturing a late-night demographic that is almost exclusively purchasing high-margin alcohol rather than sitting down and ordering a low-margin dinner. They essentially layered highly profitable revenue on top of an already heated building with staff that was, already on the clock.
But management didn't just do this in a vacuum. I mean, they had some serious macroeconomic tailwinds pushing that beverage mix higher this quarter.
Oh, for sure. High-profile sporting events are the natural traffic driver for this specific operational model, and the calendar aligned perfectly for them this time.
Yeah, the Knicks.
Right. The New York Knicks had a really deep, highly publicized NBA playoff run, which significantly drove dwell time in their northeastern locations. And then you also had major World Cup soccer matches hosted in Dallas and Houston.
Which are huge markets for them.
Massive, dense markets for the Bombshells brand.
And the dwell time is really the key variable there, isn't it? When a group packs into a sports bar to watch a 3-hour soccer match, they aren't actually eating food for 3 solid hours.
No, not at all. They order food in the first 30 minutes, maybe, and then they consume high-margin beverages for the remaining 2.5 hours.
Right.
The longer the event, the more the product mix naturally skews toward alcohol. Management recognized this natural tailwind, and they just made sure they had the late-night hours and the operational capacity to capture every single drop of that beverage demand.
So they have this VIP floor pressure generating massive cash in the clubs and a massive beverage mix shift generating cash at Bombshells.
Yeah.
But, generating cash only gets you so far. The 7% rally in the stock implies the market heavily favored what management actually decided to do with that cash.
Capital allocation is the ultimate arbiter of long-term shareholder value. Retail and institutional investors alike, They look for predictability.
Mhm.
And the capital allocation strategy RCI has laid out is exceptionally rigid.
Yeah, they are operating under what they call the Back to Basics 5-year capital allocation plan. It runs from fiscal 2025 through fiscal 2029. The stated target is to generate $250 million in cumulative free cash flow over that period. And the deployment formula is pretty much set in stone. It's 40% earmarked for strategic club acquisitions, and the remaining 60% is dedicated to share repurchases, debt reduction, and dividends.
And that level of transparency removes a massive amount of uncertainty for analysts who are trying to model the stock.
You don't have to guess.
Exactly. You don't have to guess if management is going to suddenly pivot and waste capital on some unproven pet project. You know exactly the parameters governing every single dollar of free cash flow.
But looking at the execution this quarter, RCI generated $10.6 million in free cash flow. And here is where I see a potential contradiction, right? They aggressively prioritized the balance sheet, paying down $8.6 million in debt, but they only repurchased about $1 million in stock.
Yeah, it was a heavy tilt toward debt.
But management clearly believes the stock is currently undervalued based on their own commentary. So if you believe your equity is cheap, why hit the brakes on buybacks to pay down fixed-rate debt?
Well, it comes down to market psychology and leverage ratios. You really have to look at their debt-to-trailing 12-month adjusted EBITDA ratio. Heading into this period, that ratio was sitting at 4.3 times.
Okay.
In a zero-interest rate environment, the market might forgive 4.3x, but in a macroeconomic environment characterized by persistent inflation fears and high interest rates, a leverage ratio above 4.80x acts as a huge psychological red flag.
Because it limits their options.
It puts a hard ceiling on the stock's multiple because it severely restricts their financial flexibility.
Right, at 4.3x, you are essentially on a treadmill. Any minor hiccup in top-line revenue means your operating cash is immediately consumed by interest obligations. It leaves you zero room to maneuver.
Paying down that $8.6 million in principal is a direct attack on that treadmill. They are actively de-risking the balance sheet to get that ratio comfortably below the 4.0x threshold.
Makes sense.
The market rewards survival and flexibility over aggressive, debt-fueled buybacks right now. And the strategy is ongoing. Management stated they're targeting another $8 million in debt paydowns just for the current quarter.
So they are fixing the foundation before they build another floor. By systematically forcing that debt ratio down now, they are creating the breathing room required to safely resume stock buybacks later.
Precisely.
And they even telegraphed this on the call. They hinted at plans to resume active share repurchases around October 1st, which is perfectly timed with the start of their new fiscal year.
And the market bought the discipline. They chose long-term balance sheet health over the short-term sugar high of a stock buyback, and institutional investors recognize the maturity of that decision.
Yeah, that disciplined debt paydown is undoubtedly the primary driver of the post-earnings pop. But any objective analysis requires us to flip the coin here.
Sure, we have to look at the downside.
Because the balance sheet still has some massive anchors dragging on future free cash flow. And management is staring down several structural and macroeconomic hurdles that could honestly easily derail this momentum.
The liabilities and the friction points in their operational model are significant. I mean, margin expansion is a great defense, but it doesn't solve structural cash drains.
Right. So the first major headwind detailed on the call is an earnout drag. RCI is burdened by roughly $14 to $15 million in remaining earnout payments owed to a former owner, Adam Weiss. This obligation is bleeding roughly $1 million a month directly from their free cash flow.
Wow.
That is just capital walking straight out the door.
The opportunity cost of that $1 million a month is staggering. Yes, it is a finite obligation, meaning it has a hard end date. It's likely falling off the books in about 14 to 15 months.
Right, it's not forever.
But in the interim, that is $12 million a year that cannot be deployed into high-yield acquisitions. It cannot be used to retire more expensive debt. And it cannot be used to buy back undervalued shares. It is a pure frictional drag on their whole capital allocation engine.
It hurts. And then the second major risk involves their real estate portfolio. A key pillar of their whole strategy is to raise cash by selling off non-income producing properties. But that entire initiative is currently stalled.
Yep, completely frozen.
The commercial real estate market, particularly in Texas, where a lot of these assets are located, is essentially frozen due to high interest rates and recent volatility in oil prices.
And this just highlights the vulnerability of relying on asset sales in a restrictive monetary environment. You might have a prime piece of commercial real estate and even a willing buyer.
Right.
But if that buyer has to go secure commercial financing at 7.5% or 8%, the math on the deal completely collapses.
They just walk away.
Exactly. Management is forced to sit on these non-productive assets, eating the carrying costs, property taxes, maintenance, simply waiting for the credit markets to thaw.
Which could take a while. And the third hurdle is just a glaring example of how municipal bureaucracy can destroy the net present value of a project.
Oh, this part is wild.
They have a former Dallas club location that literally burned down. It is prime real estate, and they have the capital ready to rebuild. But the project is delayed indefinitely due to repletting issues with the city. And even worse, the property is apparently governed by 1970s-era septic tank regulations that the local municipality just refuses to update or bypass.
Yeah, it's the brutal reality of physical infrastructure. Financial models always assume a clean timeline for capital deployment and return on investment.
A spreadsheet doesn't care about a septic tank.
Exactly. But here you have a multi-million-dollar rebuild completely capable of generating massive high-margin cash flow, and it is entirely paralyzed by half-century-old sewer regulations. It's just a stark reminder that operational execution is often at the total mercy of local zoning boards.
Yeah, so when you synthesize these risks, the earnout drain, the frozen commercial real estate market, the zoning paralysis, the leverage situation comes back into really sharp focus. Management noted that the weighted average interest rate on their debt is 7.05%.
Which is pretty good.
Contextually, yeah, securing 7.05% in the current commercial environment is really impressive.
The rate itself is highly competitive. The danger lies in the absolute volume of that leverage. A 7.05% interest rate is perfectly manageable when your top-line revenue is growing and margins are expanding. But the fixed costs of servicing that massive volume of debt, they do not care if your revenue drops.
Right. If consumer discretionary spending takes a hit, the debt payments remain exactly identical.
Yep. Any sudden macroeconomic shock that forces consumers to tighten their wallets will compress that free cash flow immediately. The margin of error is extremely thin. If the cash flow compresses, that aggressive October 1st buyback timeline they've been telegraphing to the market, that becomes mathematically impossible.
Which honestly sets up the critical dynamic you have to monitor heading into the next quarter, because management is heavily banking on the upcoming football season and fantasy draft parties to sustain this massive turnaround at Bombshells.
Yeah, they really are.
They're leaning their entire operational model into the sports calendar. But if persistent inflation and broader macroeconomic pressures cause a sudden, sharp pullback in consumer discretionary spending, you have to wonder, will a 64% beverage mix actually be enough to protect their profitability if the actual foot traffic in the building falls off a cliff?
It really represents the ultimate stress test for this new operational paradigm. Superior product mix and VIP margin expansion are excellent defensive strategies, but they simply cannot entirely offset a structurally empty building.
It's a delicate balancing act. The interplay between debt reduction, margin engineering, and consumer resilience is exactly what will dictate the stock's trajectory through the end of the year. To stay ahead of how these specific headwinds and catalysts play out across the market, make sure you follow the show for our daily earnings coverage.